Hello, everyone. Welcome to the January 2023 edition of the ASIS Economist Board. I'm John Nelson from M&A, and I'm joined today by Keith Prather of Armada. How you doing today, Keith?
Doing good. Ready to get this going,
All right.
New
Well,
year
today
and
we're
everything.
discussing the current I'm talking right over you.
Yeah, that's all right.
Today we're discussing the current economic environment as it relates to manufacturing. Our industrial models incorporate data going back 20 years with 18 to 20 economic indices. And in this video, and then the related subsector videos, we're going to dig into what's driving those forecasting models and related to what we're seeing in the real world. So, okay, let's get into it now.
Yep.
And I'm going to go ahead and share the models. Up we go, and there, well, I'm going too fast. Here we go. There is industrial production, and Keith, it's telling pretty much the same story as it has been. You have that trail off that goes out for 2 to 3 quarters in the first part of this year, and then starts a gradual recovery, a little bit steeper of a recovery than what we had, or not as steep, but gets up higher, if you will, at the tail end than what we were predicting before. I can tell you though that as I start looking at data coming in, we may not get to that. That may be a little bit softer in the future, rather than going up to like 104. It might be down there closer to the bottom end of the range. But that's what we're seeing from the models.
Yeah, it's kind of interesting. So one of the value adds that we bring is just that, as we travel around the country and listen to folks, we can bring some of those anecdotes back. And I just got back from a conference with about 600 transportation managers. And the real reason why we originally did this was because industrial production and manufacturing provides a really fantastic forecast tool for the transportation sector. There's a tight correlation between what happens in industrial production, specifically in manufacturing. Industrial production includes both utilities, energy, and industrial production. When you strip energy and utilities out, you just get manufacturing, which is what we model here. And it has a high correlation to like shipment counts and trucking and rail and, some of the other industries. So that's why we originally did this. Anyway, to make a long story short, while I was at this conference of 600, they were echoing what the models are showing right now. They're echoing the slowdown. They're seeing this, what they're calling a transportation recession that they're starting to go into. And we continue to see that weakness in the models, and we continue to see them pull down. And a lot of reasons for that. A lot of companies are sitting on a lot of inventory, not a lot of new reorders taking place right now. Most of the manufacturing activity is clearing backlogs, and are not seeing a lot of new order demand. So everything the model is showing us here with like possible recession kind of carrying out and now, stretching a little bit further out in the year than we had expected, but now kind of being pushed a little bit deeper into 2023 is kind of the story I'm hearing echoed from a lot of folks. And so this both corroborates it and then also gives them a forward look into what's coming. So anyway, it's very interesting, and the accuracy on this model is pretty high. So
okay, well, I'm going to go ahead and take a look at, or bring up the long range. And as you can see, the good news is that if we do that dip, we still remain above trend. But by the time you get even to the back end of it, you got a lot of room to not increase, to stay on trend. Even if you were to look at it from a 10-year perspective, the overall story, despite maybe for the next several months, is a little gloomy, if you will. Overall, the long-term trend looks good.
Well, and we can be honest with folks. We're already, we get preliminary data as it starts to flow in over the course of a month. And so we know that the preliminary data is showing us that this is going to weaken on the back end. We know that it's going to get weaker. And I will tell you this from an economic perspective. When you listen to economists, and, I'm more of an analyst than an economist, but when you listen to economists right now, they're saying that the recession, just because of the way the jobs market is working, we thought that we would get a first half recession in the US, maybe a soft, what they're calling just sort of a slowdown, if you will, or a soft landing. And then we would start to recover after that. And what's happening to us now is because of a lingering jobs market where the jobs environment stays a little bit stronger than we had expected, it just keeps pushing the recession risk a quarter further out about every time we start to get brand new data. And we're still seeing the risk, we're still seeing the softness. It's just keeps getting pushed a little further down the road. So so we both, you and I both, we've seen preliminary data. We know that the back end of this tail is going to start to soften, and that the models are starting to predict a little bit of a steeper, maybe not a steeper recession, but more of a flattening period for a longer period of time
Right.
than what we're hearing in the press.
Right.
Yeah.
If you want to take a look at the year over year, I don't know, anything you want to comment on this one before we go to primary and fabricated metals?
The only thing here is, if you look at the gray line, so the gray line was 2020, and from a contraction perspective, it is still telling kind of a soft landing story, which is the good news here. It's not saying that the economy is going to fall off a cliff or the manufacturing is going to fall off a cliff, but it is staying fairly stable. So it's more of a, manufacturers are going to have to kind of manage their cost structures, but it doesn't mean they have to go start laying off, massive amounts of workers. That demand will come back at some point in time in 2023, and those new orders will start to flow. It's a soft patch they just have to get through over the first half. So that's probably the biggest story here.
Okay. Well, let's take a look at what the metal side of things looks like. We're going to take a look at primary metal first. And this one's actually, it's interesting in that the middle looks very different than what it did, and that you've got this rise coming up, but then, it ends up pretty much the same place where it was. So although it looks a lot different, if you remember, I always like to talk about the scale. We're not talking about big, humongous shifts, but still 2 to 5 points in either direction.
Well, subscribers get the benefit of being able to go in and look at those other sectors, and there are 3 other sectors that are going to really help drive primary metals, but also creates volatility. But if you think about automotive, aerospace, and then segments of the machinery sector, like especially ag machinery, you've got a lot of heavy primary metal use there. But this curve really kind of echoes a little of what we think is going to happen in the construction industry. So you start to get a little bit of a third quarter, fourth quarter surge in non-commercial construction activity, primarily because things like steel beams that go in the ceilings of warehouses become available. There's still right now today, if you go order a steel beam to go in a warehouse, which is a big, growing segment of the non-residential construction market, you're still on anywhere from an 8 to 12 month wait list to be able to get just those beams. So you can't even do those projects until they become available. So that's why we still see this primary metal activity, this manufacturing activity, still staying pretty steady, and then kind of hitting maybe a peak late in the year. Then we have the impact of interest rates, and we start to see some of that investment start to tail off. And that's why maybe on the back end of this curve, this industry looks a little bit slower than maybe what some of the others will look like, because they will have already done all their upfront building and feeding into those supply chains.
And I did want to mention, you talked about the preliminary data. One of the things that you notice that right here in this sector right here, different than the previous month, we have a little bit of a rise before we get to that larger incline that you talked about. Different than last month, but when I'm looking at preliminary data, it's kind of, as we lean into February, it's starting to this period right here is starting to reflect more of what last month did, more of that decline closer to the bottom end of the curve here.
Yeah, absolutely. Yeah.
So year over year, this is what it looks. Again, still right there along the overall trend line, an increase and then a decrease.
Yeah, and I'm going to add one more thing. This is kind of interesting, and I think this industry is going to continue to remain volatile for one reason. And I talked a lot about this at the transportation conference, where I heard a lot of folks speaking about it. But if you look at global metal inventories right now, they're still very low. So copper, aluminum, nickel, zinc, lead, all of those commodity sectors, metal sectors, on a global basis are sitting at multi-decade lows for inventories. Okay, and if you think about the impact of that, it's fascinating, because that is with China basically still in lockdown, even though they've lifted COVID restrictions, you've still got millions of infections in the country, and absenteeism at manufacturing plants very high. So it's keeping their output low. So they're not consuming and using as many raw materials right now as they have been in the past. Europe's going through the same thing. Europe with challenges with energy availability and energy prices being high, the first thing that goes is industrial production. And so with those two major consumer markets not needing a lot of demand, it's interesting to us that inventories of these raw metals are still very, very low. And so as they start to consume again, you get a lot of volatility in the primary metal sector. And so I think we're going to continue to see, as you can see historically here, that jaggedness in the model. We can kind of continue to get that moving forward, even if the US goes through a soft patch with a little recession risk.
Okay. All right, well, let's take a look at it a little bit closer to the industrial production, and that is further down on the supply chain when that primary metal gets fabricated, if you will. As you can see, we're still looking at an initial drop for the next 2.5 to 3 quarters, and then a slight rise, which is a little better story on the back end than what we've been telling in the past. And as I look at some of the preliminary data, that might be a little bit of a false reading. A little bit, it may be that what I'm seeing is that model may look a little closer and maybe even a little worse than what last month's data was showing.
Yeah, I mean, we need to be honest with subscribers and say that, if we had such a thing as a flash report, that flash report's going to show a much weaker back end of this curve.
Yeah.
And we'll be releasing the new ASIS updates probably within 2 weeks because we do have the data. But yeah, fabricated metals, this industry feeds off of all the others inside industrial production. And as the rest of the sector starts to slow down a little bit and go into this, a little bit of this economic recession risk period, then that back into that curve is going to flatten out or drop a little bit. And so that's what we're reading, and that's kind of what's concerning us.
Okay, and if we look at this one over the long term, I don't know if you want to call this a good news or bad news story. One thing that does strike me is that the 20-year trend line, although looking like it's going down, if you look at the 10-year trend line, where that would be, which would be sitting probably in between here, in between 100 and 105, and then cutting straight over and be about the 20-year trend line. We do look like we're pretty close to it and maybe above it, even though that would be a flatter trend line than what we're looking at for the 20-year trend line. So it's not exactly a highly encouraging report, but not complete doom and gloom either. We're not talking falling off the end of the world.
Yeah, and I think again, as we look forward at some of the new data, you've looked at it. I know you alerted me to it. We're going to get closer to that 20-year trend line coming forward. So we know it's going to continue to soften. I mean, I think that's the big story here, and the big takeaway is it's not as weak as it will show at some point in time. Yeah. So.
Okay, well, that concludes our look at industrial production for manufacturing, as well as 2 primary subsectors that are the commodities feeding it, and hope you enjoyed it.
That's right. Yeah, please check out the other sectoral reports. If you're a subscriber, if you're not, get a free trial and go check out the sector reports, because there's a lot of news and information in each one of those. And so that covers what, John? Automotive, aerospace, machinery, computers, electronics, electrical equipment, appliances. Yeah. So a lot of information, a lot of intelligence about the economy in those models. So, all right. We'll hope to see everyone soon. Take care.
Bye-bye.